Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, April 22nd, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to move over to a weekly chart of the S&P 500 to get a big picture view of what has happened, and then we will look at the shorter term chart and a couple of other things here today. So first off, the S&P 500 this week down 2.75%. I have it annotated right there, pretty small over here in the right-hand corner, but we were down 2.75% this week. We closed at 4271.78. And we have a couple of horizontal blue lines here, a bunch of annotations I will walk you through, and this is going to be very, very educational, so I would encourage you to stay with the entire video and watch closely. So the lower blue line is 4,200, the middle blue line 4,350, the upper blue line 4,550, and we know that over the last month we got up to this 4,550 level. Now, intra-week, right, we can see we traded as high as 46.3730 right here when my cursor is circling, but on a weekly closing basis, because remember, weekly closes are more important than daily closes. Daily closes more important than, of course, hourly or 30-minute candles. But we can see here that we have not had any weekly closes above 45.50 since clear back here during the really the second week in January. But you know, we're on here on the third week. We closed third week of January of this year. We closed below 45.50. So we got up to this level, but on a weekly closing basis, we stalled out, and of course, we've been down for 3 straight weeks in a row, and we are now closing once again under 43.50. This 43.50 level, guys, super important support and resistance level on the S&P 500, going clear back here to June of last year. We'll come back to that here in just a second. Now, this week, again, we closed at 4271.78. This is, if you look here, over the last few months, this is the second lowest weekly close on the S&P 500 during this downturn. The only other week where we have closed below 42.75, we closed at 42.0431 here back towards the tail end of February. So this is, you know, we've been rejected, rolling over, second, you know, lowest weekly close here in the downturn. Guys, you know, it's starting to look ugly here, okay? And, you know, 3 weeks in a row, and I'll show you on the shorter term chart here where, you know, it's just kind of a nosedive over the last couple of days. So the real question here is, will this lower blue line, which is the 4,200 area, and of course 42.0431, the lowest weekly close that we've had during the downturn, the lowest point during this downturn, 41.1465, by the way, and we'll talk more about this here in just a minute. But you know, the question now becomes, since we have once again broken below the 43.50 level, which, by the way, this close today for this week makes this only the 5th weekly close below 43.50 on the S&P 500 since clear back here in the latter part of June of last year. Okay, there's 1 week right here in July, and then we have 1, 2, 3, 4 right during the downturn. So a total of 5 weekly closes, including this week that we just finished up on 4/22, 5 weekly closes below 43.50 on the S&P 500 going clear back to June of last year, guys. So it shows just how important this 43.50 level has been, but the fact that we once again closed below it, that's not good. And you know, the next support level below where we're currently trading is going to be right around this 4,200 level. And we know that we haven't closed below 42.04 during the downturn on a weekly closing basis. Our lowest point, again, 41.1465 right here on February 24th. So, somewhere, let's call it between 4,100 and 4,200 is going to be in the next real support area. And that takes us back to the trading we had in April, May, and the first part of June of last year. So really about, 10, 11 weeks or so of trading right in this area. Let's call it 4,200 plus or minus, 50 or so points. But guys, that's not a lot of trading, right? When you compare it to what we've been through here at the 4,350 level for many, many, many months, this it doesn't look likely. I mean, anything's possible, of course, right? Which is why I will never make predictions, because I can't predict the future, guys. But what I can tell you is the fact that we got rejected at 45.50 and the fact that we're falling, now that we're coming back down to these areas, unless there's some buy algorithms that kick in somewhere in this area, which there definitely might be, it would not surprise me to see us, slice over the next few weeks through this 4,200 level and start to go lower. And what I can tell you is below 41 to 4,200, there is not going to be a lot of support until we get down to around this 3,800 level. Now, for more information on that, I do want to encourage you to watch a video I produced about a month and a half ago. It is a fantastic video, probably in my opinion one of the best videos I've ever done, and I've got about 300 videos or so on my channel now over the last few years. But it's called "How Low Will the S&P 500 Go?" Guys, you have to watch that video, okay? And even if you've already watched it once, please go back and watch it again. I will link that video as well as several others. I will put the links to those in the description box below this video. So please invest some time in yourself. And I put a lot into these videos, guys, so watch the videos, right? But when you get done with this one, watch this entire video. But make sure when you're done watching this video that you watch "How Low Will the S&P 500 Go?" And I would encourage you to also check out the other videos that will be linked in the description box below this video, because you will learn a lot, I promise. Okay, so we have had a rolling correction, right, on the S&P 500 since really back here in April, right? And we really haven't made any progress. If you look back, from where we stopped here to right here, we haven't made any progress in the S&P 500 since the latter part of June, right? We've erased all the progress since the last week or two of June of last year. And when you really look at, starting in April of last year and then the lows that we hit so far, that erases all of that. So, guys, we've had this rolling correction. Now, is it possible that has bled off enough pressure to keep us going, much lower than about 41, 4,200? It's possible. However, given the backdrop, right, given what's going on around the world, supply chain issues, the Fed pulling back on stimulus, the Fed raising rates, the invasion of Ukraine, guys, it doesn't seem very likely that this level is going to hold. It is completely possible, but it doesn't seem very likely, all right? So that over the next week or two, we will, need to keep our fingers crossed that this 4,200 plus or minus level holds. If it doesn't, however, we're probably looking at least this 3,800 level. Again, watch that video, and how low will the S&P 500 go to get to get a real education on how bad this could get. So please invest some time in yourself and watch that. Now, this particular chart here is a 30-minute candlestick chart of the S&P 500 that goes back 1 month. So it's 20 trading days, basically, goes back to the 23rd of March. And the oops, it did it again means that the S&P 500 is down below 4350. But it's not just, this chart isn't just about that. I want to point out that, we closed at the lows of the week. We closed, look, this goes back a month, right? We closed at the dead lows of the last month. We closed at the lows of the week, of course. We closed below 4350. We closed towards right at the lows of the day. And you can see here we were above 4,500 on the S&P 500 after the open of trading on Thursday. And you can see that we have basically, almost every single candle, not every one, but most of the candles over the last 2 days were just 30-minute candles. Lower, 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 lower. And, of course, closing once again at 42.71.78 for the week. So pretty darn ugly. But, guys, it wasn't just equities, all right? I've got this set for 1 week. We're looking at the triple Qs, the S&P 500, and we're looking at 3 high-quality Treasury ETFs. Please stay with this, especially if you're an asset allocator, you have hundreds of thousands of dollars in your 401k, and you manage any of your own money, guys. I would encourage all of you to stay with it, but especially if you're, in your 40s, 50s, 60s, you're retired, you run any of your own money, you're an asset allocator. I want you to understand, guys, the game has changed. Now, I can help you, but you've got to let me help you, right? Kind of goes back to that, that movie, Help Me Help You, all right? So help me help you by staying with me for the next couple of minutes. But let's first off review what happened for the week. So we know that the triple Qs were down 385 for the week, the S&P 500 down 275. But look at this, guys. The 7 to 10-year Treasury ETF IEF down another 65 basis points this week. The 3 to 7-year IEI down another 65 basis points. The TLT down 59 basis points. But let's back this up year to date. All right, look at this. The TLT, the 20-plus year Treasury ETF, down 1865 year to date. It's down more than the triple Qs, right? So anybody that thinks that bonds are safe, you guys are missing it, right? Nothing is safe, especially in an environment like this. But this is how you can get hurt in high-quality bonds in a rising interest rate environment. I don't care what the yield on this thing is. You can't make up for an 18.65% drop, underperforming underperforming high beta tech stocks in the triple Q, right, by 54 basis points so far this year. And then the S&P 500 down 1037. And then look at this, the 7 to 10-year Treasury also down 1037. The 7 to 10-year high-quality ETF, guys, is down as much exactly. Now, I get it. There's a little bit of a yield there, right? But, so including the yield for this last quarter, okay, you're not down quite as much as the S&P 500. But I hope you understand what I'm trying to share with you guys. The game has changed, okay? And you're going to have to get your head wrapped around the fact that, you're not going to be able to use high-quality bonds to offset equities for probably several more years. It's just not going to work, all right? Or at least it's not going to work very well. And let's back this up. So that's year-to-date. Let's go back 6 months. And we can see that high-quality bonds down 16%, triple Qs down 280, the 7 to 10-year Treasury down 933, 3 to 7-year Treasury down 696, and the S&P 500 is only down 6% over the last 6 months, right? So on a relative basis, the S&P 500 has done better than these high-quality ETFs. I hope you understand what I'm saying here, guys. Don't be surprised if your 60-40, 70-30 portfolio isn't working. This is the reason why, okay? And it's not going to work for quite a while. It would be, my guess. Now, let's go out to a year, and we can see that the S&P 500 over the last year is up 3.31%. Everything else, triple Qs. The triple Q is only negative 246 on a one-year basis. But look at this. You've got these high-quality bond ETFs down, guys, down, all right? So, with that said, I want to encourage you to please watch the balance of this video. If you want some help, if you want a way, right, if you want to understand something that I worked on for 20 years that is allowing me to not lose money in this environment, okay, because first and foremost, right, when you're investing in the stock market, the first thing you need to understand is the key to making money and holding on to money long-term is lose as little as possible when the market goes against you, all right? Rule number 1, don't lose money. The second rule, make money, okay? But primarily, right, you don't want to lose your capital, okay? You don't want to lose your investment capital. You want to keep your losses to a minimum. And you can see right here that the traditional, the old, Markowitz approach to modern portfolio theory, using high-quality bonds to offset equity risk, guys, it ain't working, and it's not going to work for quite a while, all right? Hope you understand. I'm just trying to help you here. I'm not losing money in an environment like this, and if you want to learn how that I'm doing this, how I am not losing money, okay, then you need to watch the rest of this video. Do you have exposure to the S&P 500 or other large-cap U.S. equities? Have you ever felt out of sync with the stock market? Would you like the opportunity to increase your upside capture, decrease your downside capture, improve your risk return profile, and have the ability to sidestep major market downturns? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Would you like the advantage of knowing when it's generally safest and most profitable to be in equities, and when it's most dangerous and generally least profitable to be in equities? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Want to minimize the likelihood you will experience catastrophic losses in the market? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from Rich A. from Ohio. Hi, Rodney. I want to thank you for creating Simple Market Signals and making it available to the average investor like myself. I work hard for the money that I invest, and I want to try to get the best return for my investment. Like a lot of people, though, I just don't have the time to watch the markets closely, and I've been blindsided a few times in the past by market moves I didn't see coming. Needless to say, if I could have avoided those downturns, I would be much further ahead financially. This is where Simple Market Signals comes in. It takes complex market data and distills it down into an easy-to-use tool that anyone can use to see where the markets have been and are likely to go. It is sort of like a barometer that a weather forecaster uses, only easier to use. I like the fact that I get weekly updates from Simple Market Signals and also get updates anytime there are important changes in the markets. Your emails are succinct and to the point, and the signals are easy to understand. Depending on how much time I have, I can quickly scan the main points that Simple Market Signals gives me or do a deeper dive and read about the various market sectors and their performance outlook. Either way, I get the timely and important information I need. Thank you again for doing this and keep up the good work. Again, that's from Rich A. from Ohio. Rich, thank you so much for the feedback. I really appreciate that. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016, but I want you to understand, I cannot give advice, but this is the feedback that SC from Florida gave me, so I appreciate this. So again, SC writes, Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the question, so I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, one of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com, and I will also leave a link to this site in the description box below this video.